Welcome to our deep dive into private fund strategies. Private funds have become a cornerstone for sophisticated investors seeking higher returns and diversification. Unlike public funds, private funds operate with less regulatory oversight, allowing for more flexible and innovative investment approaches. In this video, we'll explore the most common strategies used by private funds, how they work, and what makes them attractive to investors. Whether you're new to the world of private investing or looking to refine your understanding, this journey will provide valuable insights. Let's start by understanding what private funds are and why they matter in today's financial landscape. Private funds are investment vehicles that pool capital from a limited number of investors to invest in a variety of assets. These funds are typically not available to the general public and often require significant minimum investments. Private funds can include hedge funds, private equity, venture capital, and real estate funds. Their flexibility allows managers to pursue unique strategies that may not be possible in public markets. This exclusivity and adaptability make private funds a popular choice for high net worth individuals and institutional investors seeking tailored investment solutions. World of private funds involves several key players. Fund managers are responsible for making investment decisions and managing the fund's portfolio. Investors, often called limited partners, provide the capital. There are also service providers such as administrators, auditors, and legal advisors who ensure the fund operates smoothly and complies with regulations. Understanding the roles of these participants is crucial to grasping how private funds function and why their structure supports a wide range of investment strategies. Hedge funds are among the most well-known types of private funds. They employ a variety of strategies to generate returns, often regardless of market direction. Hedge fund managers use tools like leverage, derivatives, and short selling to maximize gains and manage risk. The flexibility of hedge funds allows them to adapt quickly to changing market conditions, making them a dynamic component of the private fund universe. Let's explore some of the most popular hedge fund strategies in detail. Long-short equity strategy is a staple in hedge fund investing. Managers buy stocks they believe will increase in value long positions and sell stocks they expect to decline short positions. This approach aims to profit from both rising and falling markets while reducing overall portfolio risk. By balancing long and short positions, managers can hedge against market volatility and potentially deliver more consistent return. This strategy requires deep research and strong conviction in stock selection. Global macro funds take a big picture approach, investing based on macroeconomic trends and global events. Managers analyze factors like interest rates, currency movements, and geopolitical developments to make investment decisions across asset classes. This strategy often involves trading in equities, bonds, currencies, and commodities. The goal is to capitalize on large-scale economic shifts, making global macro funds highly opportunistic and adaptable to changing market environments. Event-driven strategies focus on opportunities arising from corporate events such as mergers, acquisitions, bankruptcies, or restructurings. Managers analyze the potential impact of these events on stock prices and position their portfolios accordingly. For example, in merger arbitrage, a manager might buy shares of a company being acquired and short the acquirer's stock. This strategy requires a keen understanding of corporate finance and the ability to react quickly to breaking news. Relative value strategies seek to exploit pricing inefficiencies between related securities. Managers might pair long and short positions in similar assets, betting that their prices will converge over time. This approach often involves complex quantitative models and a deep understanding of market dynamics. Relative value strategies can be applied across asset classes, including equities, bonds, and derivatives, making them a versatile tool in the hedge fund manager's toolkit. Private equity funds invest directly in private companies or take public companies private. Their goal is to improve the value of these businesses over time and eventually sell them for a profit. Private equity strategies often involve active management, operational improvements, and strategic guidance. These funds typically have longer investment horizons, allowing managers to implement significant changes and unlock value that may not be immediately apparent. Buyout strategy is one of the most common in private equity. Managers acquire controlling stakes in established companies, often using leverage to finance the purchase. They then work to improve the company's operations, cut costs, and drive growth. After several years, the goal is to sell the company at a higher valuation, generating significant returns for investors. Buyouts require strong management teams and a clear plan for value creation. Growth capital strategies focus on investing in companies that are expanding rapidly and need funding to accelerate their growth. Unlike buyouts, these investments typically do not involve taking control of the company. Instead, private equity managers provide capital in exchange for a minority stake, supporting the company's expansion plans. This approach is common in sectors like technology, healthcare, and consumer products, where innovation and scaling are key drivers of value. Venture capital is a subset of private equity that targets early-stage, high-potential startups. Venture capitalists provide funding, mentorship, and industry connections to help these companies grow. In exchange, they receive equity stakes that can become highly valuable if the startup succeeds. Venture capital is inherently risky as many startups fail, but the potential rewards from successful investments can be substantial. Stressed asset strategies involve investing in companies or assets that are experiencing financial trouble. Private funds specializing in this area look for opportunities to buy undervalued assets at a discount, with the aim of turning them around. This can involve restructuring debt, improving operations, or selling off non-core assets, while risky, successful distressed investing can yield significant returns for skilled managers. Real estate funds are another important category of private funds. These funds invest in properties ranging from commercial buildings to residential developments. Strategies can include core value-add and opportunistic approaches, each with different risk and return profiles. Real estate funds offer diversification and the potential for steady income through rent, as well as capital appreciation over time. Or real estate strategies focus on high-quality, income-producing properties in prime locations. These investments are considered lower risk, as they typically involve stable tenants and long-term leases. The primary goal is to generate steady cash flow for investors, with some potential for capital appreciation. Core strategies are popular among conservative investors seeking reliable returns from real estate. Value-add strategies target properties that require improvements or repositioning to increase their value. Fund managers may renovate buildings, upgrade amenities, or improve management to boost rental income and property values. These investments carry more risk than core strategies but offer higher potential returns. Value-add strategies are ideal for investors willing to accept some risk in exchange for greater upside. Opportunistic real estate strategies involve investing in properties with significant challenges or development potential. These may include distressed assets, ground-up developments, or properties in emerging markets. While the risks are higher, successful execution can lead to substantial gains. Opportunistic strategies require experienced managers with the ability to identify and capitalize on unique opportunities in the real estate market. Fund of funds invests in a portfolio of other private funds, rather than directly in securities or assets. This approach offers diversification across managers, strategies, and asset classes. While fund of funds can provide access to top-performing managers, they often come with an additional layer of fees. For investors seeking broad exposure and professional selection, fund of funds can be an attractive option. Direct lending funds provide loans directly to businesses, often bypassing traditional banks. These funds earn returns through interest payments and fees. Direct lending is especially popular among middle-market companies that may not have easy access to bank financing. For investors, direct lending offers the potential for steady income and attractive yields, though it also carries credit risk. Mezzanine financing is a hybrid of debt and equity, often used to fund business expansions or acquisitions. Mezzanine funds provide loans that can be converted into equity if the borrower defaults. This structure offers higher yields than traditional debt but with increased risk. Mezzanine financing is common in private equity deals, providing flexible capital solutions for growing companies. Special situations funds seek to profit from unique or complex scenarios, such as spin-offs, restructurings, or regulatory changes. These strategies require deep research and the ability to navigate uncertainty. Special situations can offer outsized returns for managers who can identify and act on these opportunities before the broader market catches on. Quantitative strategies rely on mathematical models and algorithms to identify investment opportunities. These funds use vast amounts of data to make decisions, often executing trades at high speed. Quantitative investing can uncover patterns that are invisible to traditional analysis, but it also requires significant technological infrastructure and expertise. Multi-strategy funds combine several investment approaches within a single fund. This diversification can help reduce risk and smooth returns across market cycles. Managers allocate capital dynamically among strategies such as long-short equity, event-driven, and macro, adapting to changing market conditions. Multi-strategy funds appeal to investors seeking a balanced approach to private fund investing. Infrastructure funds invest in essential assets like roads, bridges, utilities, and energy projects. These investments often provide stable, long-term cash flows, making them attractive to investors seeking steady income. Infrastructure funds can also play a role in economic development and sustainability as they support critical public services and green initiatives. Natural resources funds focus on investments in sectors like energy, agriculture, and mining. These funds can provide exposure to commodities and benefit from rising demand for raw materials. Natural resources strategies often involve navigating volatile markets and regulatory risks, but they can offer diversification and inflation protection for investors. Private debt funds lend to companies or projects that may not have access to traditional financing. These funds earn returns through interest payments and fees, often with customized loan structures. Private debt can offer higher yields than public bonds, but it also carries greater risk, including illiquidity and credit risk. Co-investment strategies allow investors to invest directly alongside private fund managers in specific deals. This approach can offer lower fees and greater control over investment selection. Co-investments are typically available to large or institutional investors and can enhance returns by providing access to attractive opportunities without the full fund structure. Secondary funds purchase existing stakes in private funds from other investors. This provides liquidity to sellers and allows buyers to access mature portfolios with more visibility into performance. Secondary investing can reduce risk and shorten the time to liquidity compared to primary fund investments. Private funds typically charge management fees and performance fees. Management fees are based on assets under management, while performance fees are a percentage of profits earned. These fees compensate managers for their expertise and incentivize strong performance. However, high fees can impact net returns, so investors should carefully evaluate fee structures before committing capital. Effective risk management is essential in private fund investing. Managers use a variety of tools such as diversification, hedging, and stress testing to protect capital and manage volatility. Understanding the risks associated with each strategy helps investors make informed decisions and align their portfolios with their risk tolerance and investment goals. Private funds are generally less liquid than public investments. Investors may be required to lock up their capital for several years, with limited opportunities for early redemption. This illiquidity allows managers to pursue long-term strategies but requires investors to plan carefully and ensure they can commit their capital for the required period. Conducting thorough due diligence is critical before investing in private funds. This process involves evaluating the fund manager's track record, investment strategy, risk controls, and operational infrastructure. Investors should also review legal documents and fee structures to ensure alignment with their objectives. Proper due diligence helps mitigate risks and increases the likelihood of successful outcome. Private funds operate in a less regulated environment compared to public funds, but they are still subject to certain rules and oversight. Regulations vary by jurisdiction and fund type, covering areas like investor eligibility, reporting, and anti-money laundering. Staying informed about regulatory changes is important for both managers and investors to ensure compliance and avoid potential pitfalls. Private funds are typically restricted to accredited or qualified investors. These requirements are designed to ensure that participants have the financial sophistication and resources to understand and bear the risks involved. Eligibility criteria may include minimum income, net worth, or professional experience. Understanding these requirements is essential before considering an investment in private funds. Measuring performance in private funds can be complex due to illiquidity and unique investment structures. Common metrics include internal rate of return (IRR), multiple on invested capital (MOIC), and net asset value (NAV). Accurate performance measurement helps investors assess manager skill and compare different funds. Transparency in reporting is key to building trust and making informed decisions. Tax treatment of private fund investments can vary widely depending on the fund structure, investor location, and asset type. Some funds offer tax advantages, while others may generate complex tax liabilities. Consulting with tax professionals and understanding the implications before investing is crucial to optimizing after-tax returns and avoiding surprises. Transparency is a key concern for private fund investors. While private funds are not subject to the same disclosure requirements as public funds, many managers provide regular updates on performance, holdings, and risk exposures. Clear and timely reporting helps investors monitor their investments and builds confidence in the fund manager's capabilities. Strong alignment of interests between fund managers and investors is crucial for long-term success. Many private funds require managers to invest their own capital alongside clients, ensuring they share in both the risks and rewards. This alignment encourages prudent decision-making and fosters trust between all parties involved. Environmental, social, and governance (ESG) considerations are increasingly important in private fund strategies. Many funds integrate ESG factors into their investment process, seeking to generate positive social and environmental impact alongside financial returns. Responsible investing can help manage risks, attract capital, and align with investor values. Technology is transforming the private fund industry, from data analytics to automated trading and digital platforms. Advanced tools help managers make better investment decisions, streamline operations, and enhance transparency. Embracing technology can provide a competitive edge and improve outcomes for both managers and investors. Private funds are increasingly global, with managers and investors participating in markets around the world. Globalization offers access to new opportunities and diversification benefits, but it also introduces additional risks such as currency fluctuations and geopolitical uncertainty. Understanding the global landscape is essential for successful private fund investing. Private fund industry is constantly evolving, with new strategies emerging to meet changing market conditions and investor preferences. Recent trends include increased focus on ESG, greater use of technology, and growing interest in niche sectors like healthcare and fintech. Staying informed about these trends can help investors identify opportunities and adapt their approach. Investing in private funds comes with unique challenges, including illiquidity, complex structures, and limited transparency. Investors must be prepared to commit capital for long periods and conduct thorough due diligence. Despite these challenges, private funds can offer attractive returns and diversification benefits for those who understand the risks and rewards. Future of private fund strategies looks promising, with continued innovation and growth on the horizon. As markets evolve and investor needs change, private funds will adapt by developing new strategies and leveraging technology. Investors who stay informed and flexible will be well positioned to benefit from the opportunities that private funds offer in the years ahead. Summary: private fund strategies encompass a wide range of approaches, from hedge funds and private equity to real estate and direct lending. Each strategy offers unique benefits and risks, making it important for investors to understand their options and align them with their goals. By conducting thorough due diligence, staying informed about industry trends, and working with experienced managers, investors can unlock the potential of private funds and enhance their portfolio.